All right, thanks, Tom. This is Dan Russo. I'm the Chief Market Strategist at Chaikin Analytics, and we're really excited to have Leo Valencia, the co-publisher of Gamma Optimizer, presenting today. Leo is an electrical engineer with more than 20 years of experience in research and development products. With a PhD in physics from Stanford University, he was a member of the technical staff at Bell Labs Lucent Technologies in the RF and analog simulation department, and also a senior member of consulting staff at Cadence Design Systems with more than 15 years working on analog and digital simulation software projects. His expertise is in the area of software development for highly specialized and mathematical problems, in particular root cause analysis algorithms and optimization solutions with a diverse set of problems, for which he has been awarded a couple of patents. Leo has been researching and data mining price variance patterns and index options for the past 24 years. He's developed a comprehensive modeling and simulation framework for volatility and variance, as well as several proprietary options pricing models with stochastic volatility that are used as part of a fully fledged statistical arbitrage package. His long Gamma Optimizer, enabling traders to identify the optimal strike price and expiration date in selecting options, is available via subscription on the Gamma Optimizer site, which was launched in November 2016 with Advice Trade and Elliott Wave Trader. So we're going to throw it right over to Leo and let him take you through the presentation. Leo, the floor is yours.
Thank you, Dan. Thank you for the kind introduction, and welcome, folks. I really appreciate everyone joining for this talk, and we are going to talk this afternoon about the Long Gamma Optimizer, which is a tool that I developed to help myself, my own trading. Is one part of several tools that I have, and let's say that this is the simplest one in a sense, no, even though it's very complex. And the presentation is just to help you to explain why we need a long gamma optimizer, what the thing, why it is going to help you with your trading, and why do we need one for. So the problem that we try to solve is choosing an option. So as traders, you know, you come from the stocks world or the futures world, you know that trading stocks or futures is very simple because there is only one underlying that you trade. Now, if you want to trade SPX, you use the ES mini futures or you use the SPY shares, and it's very simple. You just buy and sell that thing. But like with options, there are too many of them. No, even if you know that you want calls or you want puts, there are too many. For instance, for index options, for SPX, for instance, there are more than 8,000 in total options. No, because they have different expirations and different strikes, and there's too many to choose from. And even something like Apple, which is a very liquid underlying that has a very healthy option chain, then you have about 1,500 options between calls and puts. So as a new trader, as someone that is new to the world of options, it becomes daunting, a daunting task to find the correct option. And how do you pick one? So for that, I am going to talk about Gamma. And the title is Gamma and Other Demons, or Why Optionality is Not Leverage. And that's kind of what I want when we end this presentation. That's the key concept that I want everyone to have in their minds. Why optionality is not leverage. Why options are not like anything else out there. So if you have been trading options for a little bit, or if you are new, even if you're new, you know at least one thing about options. And the thing you know about them is that they lose value over time. You buy an option, and from the moment you buy it, you start losing money. And this is kind of mind-blowing. Like we kind of accept this fact. We just, oh yeah, by the way, options always lose money, but no one wonders why. Why do options lose money? Why, for instance, shares don't lose money? Why futures don't lose money with time? It's only options. So that right there is giving you a hint that options are very special. And there are many ways to approach the subject of time decay, but I like to approach it from the point of view of convexity. So the reason options lose money over time is because options have a convex profile. And don't worry, I'll show you pictures and everything. But right now, what is convexity? A convex profile is, imagine like like a mirror or like a magnifying glass. Now, those kind of profiles where they are not linear. This is the opposite of linear. They kind of curve and move kind of exponentially. So this convexity there is a property of options is very valuable. It's really, really very valuable. And that's why options lose money over time, because option dealers, the people that are selling you options, are giving you this tremendous optionality, and they want to kind of be compensated for it. So you're paying for optionality, for convexity. You're paying in two ways. You're paying for it in the price that you pay for the option, and you're paying for it with the time decay. And in this discussion, I am going to use these three words, like convexity is the same thing that optionality, and gamma is just a quantification of it. It's like how convex the thing is. So, and this is the thing for everyone that is new to options. Like everyone that is new to options think that they are linear, because you read the literature, you go to the websites, and you see the diagrams of profit, and you see kind of a straight line. Either you lose money or you start making money if the option finishes in the money, and everything looks like in a straight line. But the truth of this thing, the truth with options, is that they are non-linear. There are no straight lines with options. However, in order to see the non-linearity of the product, you have to buy it and sell it before expiration. So it's only in that period of time before the option expires that you get to see the non-linear nature of the product. So for those of you that buy options and hold until they expire, you are just missing the whole thing. You're just missing the whole point of options. Options are not designed to be held until expiration. They don't do it. It's a waste of money, because the convex profile manifests itself really quickly during the trade, during the period that the trade is open. So that's how I trade options. I open options today and I close them a few days later, a week later, but I never allow my options to get closer to expiration. So let's look at some convexity charts here. So here finally we get a diagram that will give you an idea of what convexity is. And this is, of course, this slide was done, I don't even know how many years ago, when SPX was trading around 2,370. That seems like a few decades ago, But this is valid. This was a real option, and this is a real profit and loss diagram. The x-axis contains the different prices that SPX could take at that time, and the y-axis represents the return of the profit of the trade in dollars. So this trade in particular was only 82 cents, and it was 82 cents because the option only had 2 days to expire. So this is just for example purposes. I'm not saying that you should trade options with 2 days to expiration. It's just I wanted to exaggerate the non-linearity of the option, which is more present for this kind of really short-term options. So you can see how, if the market moves in the direction of the option, which is a call, you can see the profits growing exponentially. This is something fantastic, You start here at 82 cents, and suddenly you're making $4, and suddenly you're making $8, and suddenly you're making 12. That's kind of like a mind-blowing feature of options, where profits can grow exponentially. And what happened to losses? Let's say, it didn't go our way, the market actually moved the other way. Well, you can see the losses, nothing happened to them. In fact, they are kind of capped, the options are limited to the premium you pay. The loss is limited to the premium you pay for it. And that's fantastic. So you have this really limited loss with almost unlimited profit. Not only limited, but tremendous profit. And this is convexity, folks. This is optionality for you. And this is the power that only options can have. Not other product in the market can deliver this kind of profits. So this is an idea of convexity. It's very powerful. Okay, so now let's talk about gamma. Okay, so gamma, what is gamma then? Well, gamma is a measure of convexity. So think about it as a number. It's a number that tells us how convex something is. And for that, I'm going to use this chart here that is showing the same profile, profit and loss profile for the same strike option, but for different expiration dates. This is the red one is only for options with 2 days. the green one for 14, and so forth and so on. And this, by the way, was all real data. Now, this is at that time when I did this, it was real-time data. So you can see that options with different expiration timeframes have different profiles. Look at this one. The one with 2 days to expiration is really convex. I mean, this thing is incredibly convex. And then suddenly the other ones are not that convex anymore. For instance, the purple line with 53 days to expiration is, to me, to my eyes, in this diagram, they look like a straight line. So you notice how the nonlinearity changes, and that's what gamma is. Like a high gamma measures something like this, and then gamma starts to decrease, and I will say that this option that looks like a straight line has almost no gamma on it. So this chart is helping me to define two things. First, gamma as a quantifier of convexity, and two, you can see how gamma changes with time. Gamma is more prevalent in options that expire really soon. So you have lots of gamma on those options. And as you start to move away, picking options with farther and farther away expirations, you get less and less gamma on them. That's kind of like what the chart is telling you. And that's the reality of the situation. The reality is that options that expire really far away in the futures, for instance, options that expire like 1 year from now or 2 years from now, those are called LIPS options now. So those options have no gamma. Those options have almost no gamma, almost no optionality. And I always keep telling the members to my service, don't use them. If you really want to, I mean, you can use them, of course, you can use whatever you want, but if you really want to optimize, if you really want to increase and use your returns, if you want to really enhance them, exploit the property of the instrument, and options have optionality. What is the point of using options that don't have any gamma? Options without optionality, it really makes no sense, but yet it seems that it's a popular product out there. So let's keep moving here. We talk about gamma and time. Now let's talk about gamma and something called moneyness. Moneyness is a measure of how much in the money or out of the money an option is. That's what moneyness is. So this chart is a chart of different options with different degrees of moneyness. And you can see what are the returns for each of them. So let's say that the 2,370 call is at the money, yes, at the money, and it keeps going out of the money. So moneyness starts to be reduced for these ones. And you can see what happens to convexity. You can see what happens to the profits. At the money option, it looks convex enough to me. It looks really nice and convex. But notice how the out of the money options start getting more and more convex. In fact, well, I'm just exaggerating here. This one with 2,400 is almost no losses. And yet it has really good profits. So if I plot this in terms of the ratio between the profits and the loss, this looks fantastic. So we can see that gamma somehow also depends on the moneyness of the option. So not only we have different gamma values at different expirations, but also even within the same expiration, we have different gamma values. And this is key because when you are trading gamma or when you're using gamma to enhance your profits, you want to pick something that will maximize it for you. And every option has a different thing. So that brings me to like here, my masterpiece, this three-dimensional quote chart that I have. This is a very interesting chart. This chart is three-dimensional in a sense because it's plotting three different things. It's plotting the moneyness of the option on the x-axis. This is, or at least plotting yes, this is the moneyness. There's different strikes for the options. Then the y-axis is actually finally gamma. This is not profit anymore, but the actual gamma value as a number. Gamma is just a number. It can range from 0 to something. And then the color itself represents time. So it's kind of three-dimensional, but I'm cheating here. I'm using color as my third dimension. So I just want to go over this chart and show a few things from it. Now, what can we say about this chart? Well, we can say a bunch of stuff. I can say the same thing I already said before, where gamma is actually tends to be higher around the options that are really close at the money. The dotted line represents the level that XPX was at that time. And you notice that gamma tends to be really plentiful around that value. No matter the expiration, you see the same. It's not quite at the center, but I mean, yeah, it's around that area. You have lots of gamma, And notice how gamma drops dramatically towards any side. Even so, this is a call. So out of the money calls have like very low gamma. The higher, the farther away you go, gamma pretty much goes to zero. But notice that it's almost symmetrical. It also happens for in the money options. That's something interesting. And that's something that I also discuss with my members. Like in the money options, more options that are in the money don't have that much gamma at all. No, I mean, the most plentiful gamma is right here. So in the money options are quite expensive and they don't have any gamma, at least out of the money options are cheap. So it's something interesting. I have people that, well, I mean, I have met lots of traders that only will trade in the money options because they are afraid of time decay. And of course, if you don't have gamma, you don't have time decay. So you are not using options the way it is. But from this chart, we can also tell that gamma changes with time. Look at this, like the options with only 2 days on them have gigantic amount of gamma. But as time passes, the gamma is kind of like disappearing. Like even after 25 days only, options like not even a month away, the gamma is really low. So it's giving me a hint here. I'm getting a couple hints. I'm getting the hint that, well, if I really want to maximize gamma, I have to kind of like use options that have little time of them. Please don't use 2-day options. This is like too much. But I mean, in general, if you have, you can try to choose something that is closer, that the expiration is closer. And also notice that gamma it peaks around the at the money option, around the out the money strike. So right there, for those of you that are really observant, you can start seeing some dynamics of option trading. Like you can, from this chart, you can come up with a couple of strategies when trading options. So for instance, let's see, I just want to buy options and I want to profit from the move towards my strike. So imagine for a second, just for the sake of argumentation, that we buy the 2,400 strike with 2 days to expiration. I am exaggerating, but just imagine, no? So notice that the gamma value is really low. So and also the option is really far away out of the money. So you're buying cheap gamma here, like incredibly cheap gamma. Now this option will cost you nothing. It almost has no gamma. But notice something interesting. Notice what happens if SPX actually starts to move, or if your underlying starts to slowly move towards your strike. So this option will start getting more and more moneyness. And what happens with the moneyness? So gamma starts to increase in a nonlinear way dramatically as the option starts to gain in moneyness. So for instance, so you start here, cheap gamma, and then the move up happens. Look at what gamma is doing. Gamma is increasing, is increasing, is increasing, is increasing dramatically. And finally, if this SPX finally reaches, or the underlying reaches your strike, you will get the maximum gamma possible that you could get from that position. I mean, you cannot get anything else. In fact, if the underlying keeps moving, then your option actually starts to underperform, because you notice what happens to gamma. Gamma starts to decrease and decrease and decrease and decrease and drops to zero again. So you see right there, there is kind of a strategy right there. The strategy is, if I want to enhance my profits in a move, I should look for cheap gamma, and I should allow gamma to get fat and fat and fat, and I should unload when it's fatter. And what does that mean? That means that if you hold in the money options, you are just wasting money, because this is an in the money option. Once the underlying moves and your option becomes in the money, you're just wasting money, because any moves up will deliver less and less and less and less profits. So you are holding tremendous amount of risk for nothing in exchange. You see, here we were holding no risk at all because it was so cheap. We have no profits, it was cheap. But here, now we have lots of profits accumulated that can quickly dissipate. So my recommendation is once your out of the money options becomes in the money, sell it, take profits, run. And people say, well, what happens if the underlying keeps moving up? What happens if the stock keeps moving up? Well, just buy something different. Just go and start the cycle over again. Go and design a new trade, look for other strikes, for other expirations with low gamma, and repeat the cycle if you still think that there is juice in the move. And also notice how inefficient is to trade in the money options. If you buy an option, for instance, that is here in the money, the option has low gamma. And what happens if the underlying keeps moving up? The gamma starts to decrease. You are actually losing money here because, you're making money, but the profits are reduced because the gamma is dropping. And notice something even worse. What happens if it moves against you? The gamma goes higher. So if you have in the money options, you're accelerating the losses and accelerating the profits. And I don't know why anyone will want to do that. I don't understand, So anyway, that's kind of what the this chart is telling you. And this is from a point of view of someone that buys options. What happens if we reverse the roles? What happens if you are a little bit more sophisticated, you are not that new, and you have heard that selling options is where the money is? Like, like we need to sell premium because that's where the money is, and the people that buy options lose money all the time. And I tell you, okay, yeah, selling options have its place. You can sell them, but if you're going to sell options, be aware that you're actually selling gamma. So if you get short an options, you're getting short gamma. So if you sell this option, you are on the opposite side of this tremendously, incredibly profitable trade. So why would you want to be on the other side of this kind of trade? So if you sell options, be on the other side of trades that are dumb, like this one. You want to sell cheap gamma, sell options right here, and even if you lose money, you lose little and you gain a lot. But my recommendation for the option sellers is a no-brainer. Selling options is a no-brainer. What you want to do is to sell around peak gamma. Just sell around this area and notice what happens. If you sell around this area, no matter how the underlying moves, you are fine because gamma is actually decreasing. Can you tell that? So if I get short gamma here and the thing moves away, even if it moves against me, I don't care because gamma is actually reducing. So I am short a quantity, which is becoming smaller as the thing moves. So there is, that's a good thing to be. It's a good position to be in, the position of being short something that is decreasing. And the only way you can do that is in this area. So if you are a seller of premium, try to focus on near at the money. It's like really near this dotted line. There is no point on going out of the money, which of course is what everyone in the internet does. Everyone in the internet recommends selling this really out of the money because it's so easy. It's only 20 cents and you will get to keep them. And I'm telling you, no, don't do it. You don't get to keep them. You're selling this 20 cents, but you are in the hook for who knows what will be here. So if you're short gamma, just make sure that you are short peak gamma. Anyway, I spent too much time on this chart, but that's kind of the idea. It is a very powerful chart and it's very simple to create and has been created with real life prices. So let's keep moving. There is an intimate connection. Well, you will be asking, for those of you that know a little bit more about options. Okay, what happened about all the rest of the Greeks? What happened about Vega? What happens about Delta? What happens about Rho and all these things? Like, why do you only talk about gamma? Well, the reason I only talk about gamma is because everything else is connected to it. I will say if you know the value of gamma, you can know the value of pretty much everything else with the exception of Rho. That's it. So, and no one cares about Rho. That's it's the lonely Greek that no one cares about. Very few people care about it. I don't. So, okay, so there is a connection between gamma and theta. And for those of you that don't know what theta is a measure of time decay. Now, theta is this parameter that measures how much decay an option will have. And there's a a connection between the two, and it's a law of the universe. You cannot separate them. I mean, if you can create a position by some magical mean where gamma and theta are completely separate, you could be immensely rich. I mean, I'm not kidding you, immensely. So of course that doesn't happen. No, there are no free lunches in the market. So theta and gamma are connected, and the connection is terrible. They are always of the opposite sign. Always, always, always. And the magnitude is directly proportional. So you have a high gamma, a high positive gamma, you have a high negative theta. And that's terrible because it means that the higher the gamma of your position, the higher the time decay of your position. So you see, no free lunches. We saw in the previous chart that peak gamma is nice and all these things, but you know, the problem is these options decay at tremendously incredible speed. For instance, this gamma, these options with 2 days have lots of gamma, yet those options also have lots of time decay. And this option with 25 days only they have very little value gamma, then they have very little time decay. So you see, it is a game, and you cannot separate it. And that's the reason. If you like the holy grail of trading, I don't know what is your personal holy grail, but I mean, my personal holy grail is to be able to come up with a product that has positive gamma and positive theta. If that somehow someone invents something like this, we could be rich right away, no? Because we have positions with tremendous gamma and they don't decay, they actually gain with the pass of time. Anyway, there is also connection between gamma and vega. And vega is a Greek, is a parameter of option modeling that tells you how sensitive an option is to changes in implied volatility. So in this case, they are the same size, okay, the same sign, at least, no, at least it's good that they are the same sign. But their magnitudes are inversely proportional. I mean, there is never a free lunch, no? So if you have a high gamma, you have a low vega, no? There is never something like, oh, I want a high vega, high gamma. No, if you get tremendous high gamma, you have almost no vega, and vice versa. If you have incredibly high vega, you have almost no gamma. And why is this important? Well, it is important because options are very sensitive to implied volatility. So implied volatility, it is kind of a magic thing. You know, implied volatility is nothing other than just what option dealers want to charge you for an option. That's basically, sometimes they are worried, sometimes they think the war will end, and they overprice options. And we basically say, oh, implied volatility is too high. So this is how options react. High vega means that if option dealers start like getting concerned, the prices of the option will change a lot. And low vega means like the prices of the options will not change that much, even if option dealers like freak out. And it has practical consequences. Observe this. For instance, options with 2 days to expiration that have tremendous amount of gamma, these options almost have no vega on them. So, you know, the world might end, or option dealers will think that the world is ending, but yeah, the effect in net dollars is almost nothing because there is almost no vega. Gamma is gigantic and vega is very little. However, notice that as we move through the expirations, the gamma starts getting reduced and reduce a lot. That means that vega for these options is starting to get higher. Imagine this is the 25-day option and it has low gamma. Vega should be really high. Imagine something with 1 year on it. Worse yet, imagine something with 2 years on it. These options have no gamma. Gamma is almost zero. And if they are inversely proportional, what does it mean for vega? It means that vega is gigantic. What you really have when you are trading leaps, when you are trading options that expire long away, you are not actually betting on direction. You are not betting on the movement of your stock. You are betting on implied volatility because your position is dominated by vega. And I don't think most new traders realize this. When you trade really far away options, you are trading vega. You are a vega trader, and that's, I don't know. I mean, if you know what you're doing, more power to you. But like, if you don't know, you don't want to trade vega unsuspectedly. I mean, because if option dealers may start to like become complacent, like say, oh, nothing will happen, the world will be fine next year. Everything is calm. Then implied volatility decreases a little bit, but because of the high vega, your options lose lots of money, and you just lose money on the option. Even though the underlying is moving and is moving well, your option is losing money because it has gigantic amount of vega. And remember, vega is a connection to something that is not under your control. It's something that's called implied volatility, and that's the whim of the option dealer. So if you, I prefer to be really long gamma, high gamma, and no vega. I don't want to be influenced by option dealers in that sense. Okay, and this slide, I always skip over it because this is just exactly what I just explained. This is kind of the relationship between the two things, no? So, okay, so now we arrive to the crux of this thing. We want to optimize our option trading. Now we want to really extract the maximum profit from my option trades with a particular option. So, and I will tell you that's very simple. Conceptually, the only thing you need to do is to buy cheap gamma and sell expensive gamma. That's it. You know, there is no secret to this. I mean, if you can buy cheap gamma and sell it when it's expensive, it's fine. Or vice versa, you can sell expensive gamma and buy what is cheap. And this is visualized easily from here. Just buy gamma around this area and sell it around here. Or buy gamma around this area and sell it in any of these two sites. No? So, but of course, those kind of things are easier said than done. No? But there is a consequence. If you want the benefits of really having optionality in your book of options, then there is no other way around. You have to focus in near-term options. No, that's the fact of life, because gamma is more present in near-term. And I don't mean something that expires tomorrow, for instance. No, I'm not saying that you have to buy options with 1 day, but I'm saying 14 days, 20 days, something within a month. Something within, okay, 45 days. No, I am willing to go even 60. I mean, I'm being generous. So try to focus on something that is near term. If you start focusing on things that are far away, you know, maybe you are better served doing something else than using options, like probably buying a stock on margin, no, than buying options. But that's the reason. The reason is that, and also out of the money. Focus on out of the money options. Don't buy, or I mean, I will not advise buying at the money or in the money options. It's a waste of money. You're buying options that you're buying peak gamma, basically. You're buying the most expensive gamma, and as soon as the move happens in your direction, that thing will drop off massively, as you saw on the chart. So it's very inefficient way of trading. Now, if you want to maximize your profits, stay away from at the money or in the money options. Okay, so let's do this a little bit more formal. Now let's try to formalize this methodology. Now, so and this can be done by hand. You can select cheap gamma options with cheap gamma. You can select options that don't decay much. So yes, you are buying options with gamma that is cheap, but remember that gamma and time decay are connected. So you have to look for this decay. You want to find the right balance with decay. And also you want to hit the peak gamma for that particular move that you want. No, if you expect something to move like 20 points tomorrow, you want to design a trade that will achieve peak gamma after 20 points. No, that's how it is. And also, if the move is against you, you want something that, okay, I don't care. You know, it could be against me and I don't lose that much money. And finally, you have to take into account vega risk. So if you are concerned about vega, for instance, we are coming like what happened right now. You know, back in February, implied volatility went through the roof through the correction. And if you bought options, in particular, if you bought long-term options in SPX around that time, you are out of luck, my friend. No, I mean, you must be sitting on quite an amount of red or not such a good profit as you expected, because the implied volatility or faraway options dropped dramatically, but dramatically is dramatically, and it has a heavy impact because they have lots of vega. So, you know, in order to optimize an option trade, you want to make sure to know your vega risk and, you know, try to stay away from it. Or you can do the gamma optimizer. I mean, the gamma optimizer is a tool that does all these things for you. I wrote this tool, so mathematically could find all these things. Now, it could design trains in a way that it will maximize all of those things and under the hood, and you don't have to really be aware of them. No, you don't know how to compute gamma in the first place, for instance. So that's what the gamma optimizer is. So it's a very useful tool. I want to do a disclaimer here. The gamma optimizer is a tool. No, it's like a calculator. It's like the tools are only useful if you know what to do with them. The gamma optimizer won't tell you where the market is going. It won't tell you what the earnings will be for something. I mean, there is no way you can know that. But if you have a thesis, if you know how much, or if you have an idea on how a particular stock or index will move, then you can use the gamma optimizer to find the right expiration and a strike for that move. No? So you have to have the thesis. I cannot provide you the thesis. The gamma optimizer won't give you the thesis. You have to do something else. For instance, something like what we do in ElliotWaveTrader.net with, Elliott wave theory, or something like Mark does with Chaikin analytics. You have power gauges and other things. So if you have a system from the outside, then you can use the gamma optimizer. I mean, you have to have something. You cannot make money just by clicking. No, like just, okay, let's see, I will hit enter and I'll become rich. No, you have to take risk, and you have to have a coherent thesis for this. I think I can show it briefly. Tom, it's okay if I do a little demo?
Absolutely, I think that'd be great.
Okay, so let's do a little demo. I'm here at the gamma optimizer, so let's do the optimizer tool. The optimizer tool is just a web application. You don't need to install anything. You just visit the web and you will see the thing. And we can do something here. So I'm going to do something with XPX. Let's get the data. Remember that XPX is something like 8,000 and growing now, because they keep adding new expirations. Like we used to have only Fridays, now Wednesdays, now Mondays, and probably next year every day we'll have an expiration, which I really actually looking forward to. So let's simulate something. We have had a tremendous move up in the past week. No, I am very happy. I was riding that move up with gamma. I was riding it tremendously. I just closed position with almost 2,000% return on it. It was incredible. But let's see what the optimizer says. Let's imagine for a second that we'll move 50 points, which is about 2% on the next week, the next 7 days. So this is just, I'm not saying that the market will move 50 points. I'm saying that I'm just testing this, but you might have your own thesis of what the market will do. And then you click the button plot, and it shows you, gives you an answer. No? So it is telling you 3 suggestions, and each suggestion tells you the strike, the potential return, the risk reward, the cost, and the expiration date. And how it arrived to this, you can see here in the plot that this is the profit and loss profile for pretty much all near-term expirations. And you can just basically pick something here. I bet if I click here, that's what it is. Now you can examine the things. So it is telling you what is the return, and this is what I was talking to Tom before the presentation. Option dealers are getting smarter now. They are actually pricing upside now. In fact, it shows you how much upside or move is already priced. So for the next 7 days, the market is pricing a 46.5 points move up or down. So they are getting smarter, those guys. So that's why the return is not that impressive. Let's do something really unrealistic. Let's imagine another 100 points. Now, something that we moved almost 100 points last time. So here you can see tremendous returns, because this is completely underpriced now, and you can see the potential returns. And this works with pretty much all American equities. Now you can use any American equities or index here, and you can simulate up or down. For instance, for those of you looking for a tremendous move down in 7 days, now I'm going to just imagine that we move 100 points, and it recommends puts, no? And it recommends this particular strike with this expiration. It gives you get around 1,000% return on it, and it costs you around $325. And that's kind of the gist of it. Of course, it does more advanced things. No, it has a bunch of stuff like I use a traditional volatility surface, but you can do an stochastic volatility surface for those of you that are more mathematically inclined and want to see like a full-blown simulation of the volatility surface during the move. This is because implied volatility changes as the underlying moves. In particular, in index options, implied volatility changes a lot with the market moving. Now it tends to drop when it moves up, and it tends to go higher when the market drops. So my stochastic simulator includes those effects, and you will see them here. Let's imagine that we have some stochastic simulation, and it does indeed changes, and it changes the type of option being used for this. Then notice that now is something May 21st that is delivering the most profit, and it's a different strike, and it has a slightly higher return. And this is including the effects of implied, like more accurate effects of implied volatility increases if 100 points move down happens within 7 days. So this is what the gamma optimizer is, and I hope it is useful to you folks. And I don't know, Tom, what else you want me to show?
No, I think that's fantastic. I think we also would want to maybe give an opportunity for people to ask questions here. Just would also like to interject while you're getting those questions in. Again, use the questions box and you can submit those, and we'll pass those on to Leo and see if we can get to all of them this evening. But if you've never tried ElliottWaveTrader.net before, there's a 15-day free trial that you can get started with just your name and your email, and you tell us what you want your password to be, and that's it. You're off and running for 15 days. And inside of there, there's multiple services. And why I think that's important to discuss, even though we're talking about the Gamma Optimizer service tonight. As Leo said, this is a tool, and that tool is you're gonna come into using this tool with a thesis, whether it is about the S&P or if it's about Apple or Facebook, whatever stock or index that might be that you're interested in following. And that could also be something, as Leo said, that's coming from Chaikin Analytics, or a scan that you like to do in your charting platform. Whatever it may be, you can come in and now try to optimize that trade using options and then using the optimizer tool, using those inputs. So what's nice about the 15-day free trial is there are other services that we offer at ElliottWaveTrader.net in addition to Gamma Optimizer. So you could take one of the services that focuses on individual stocks and where we think individual stocks are heading, or some that focus on gold or individual specifically gold stocks. There's a lot of different services that you can pick and choose from that have different focus, and then they can marry very well with also the optimizer service. Now, last thing I'd like to put in, and I'm going to give you all a link in the chat box here just in a moment to take you back to that the homepage where you can get started with the 15-day free trial. But what I did want to touch upon too is that inside the Gamma Optimizer service, and Leo, maybe you could, just as we're letting some questions come in a little bit more here, talk about a little bit more about what goes on day to day inside of the service. So it's not just you register to the Gamma Optimizer service and here's the tool and good luck to everybody. Could you talk about the day-to-day interaction that people would expect from your service?
Of course, Tom, no problem. Yeah, so you have a room, and in this room I post all of my my thoughts about volatility and earnings analysis. You can see here some things, I discuss questions from people. I suggest trades, and I post, for instance, different states of volatility. Now, for me, I focus tremendously on volatility, and I try to post updates along the day about how volatility looks like. So I offer kind of like a play-by-play commentary on what is going on during the trading day, and trying to see, for instance, I show something like gamma imbalance, where you can see where most of the gamma is per strike. So you can use that information to, if you are a momentum trader or someone that trades based on these things, you can see that these ranges are important for the market because there's lots of option interest. I also do control charts where I show intraday realized volatility, and I just basically please, it's most education and trade suggestions and technical commentary.
If someone was tracking Apple, maybe they're new to the optimizer, and I'm just picking on poor Apple here, but are they able to say, ask you a question about, this is kind of my thesis and I'm looking to try to craft a trade, but I'm a little stuck. Are you able to give insights into, what type of options might be looking good based on what their thesis is.
Of course, I mean, the low gamma optimizer is a tool that is very useful for long gamma trades and for trades where you want to play direction and where you want to look for cheap options and, and profit from it. But sometimes there are no good trades in the long gamma space. So people ask me questions and I can design even more complex trades for you. So you tell me your thesis, I can go look and I can see if a long gamma trade is suitable for the situation, or if it's better to do some kind of hybrid trade or short gamma, and I could do really advanced trades for you. And I can also, post simulations of those trades for you, and it tells you, okay, this trade will give you this kind of profit. Those are the risks associated with it. Yeah, I try to walk you through the design of a trade, even if it's not done using the long gamma optimizer because the regime is not suitable. For instance, before earnings, options are incredibly expensive, so there is no point on buying them before earnings. So I design other kind of things for people. Yes.
No, that's fantastic. And I know you touched upon this a little bit earlier, but maybe we could just revisit it about users that are predominantly interested in selling options, or at least that's part of their long-term strategy with positions that they hold. They may not be able to use the optimizer directly, but maybe we could just touch upon again where we see the value, or where you see the value in if you're going to sell options.
Yeah, so for option sellers, I mean, I do have suggestions, and I try to first steer people away from taking undue gamma risk, to point to them like this idea is incurring lots of gamma risk, and I suggest structuring the trade a little different, like a butterfly trade or a calendar trade, where you are net seller but you are not incurring unlimited risk. So yes, I try to help everyone. So the room is for everyone, for option buyers and option sellers in some sense.
Right, so it won't be actually through the optimizer tool itself, but there's still a lot of healthy discussion. And as you can also see, I mean, you see Leo there he's the top post, and he's very active in the room, but there's other people coming in and actually sharing ideas. You also get to see the back and forth. So because it's not done in private, if someone asks about a certain stock that maybe you weren't thinking about, and then you'll see the discussion and the trade that's being crafted. And then if, in reflection, you look at that and you see, hey, that might be an opportunity that I'd be interested in. I was looking for something along those lines. You get the benefit of all that interaction that's going on in the room. So Leo, with the service, are there trade alerts that go along with access to the Gamma Optimizer service?
That's correct. We have, when I generate a trade idea, an email gets sent, and if you configure it, you can actually get a text message, depending on how you configure your thing. But at least you get emails when I send a trade notifications. For instance, I have this one right here. This one is a trade idea, and this one got sent as an email. And this was a trade that we got out with 500% in 2 days. And also, so this is a closing notification, and there is also an opening notification for it.
That's perfect. If any other any other questions are out there, please don't hesitate to bring those in. And we also understand that this is a dense topic. So in the chat box here, I'm also going to give you a link. We have some free educational tools. There are some additional videos where Leo's going over not just the optimizer, but also some of his strategies, how the optimizer can be used for things like hedging, if you already have a position. So there's a lot of other tools that are accessible, not only in the Gamma Optimizer service through the room, through having access to Leo, but just also other tools and ways you can use the optimizer. So just right now, I want to send you all of that link to the About Gamma Optimizer page on ElliottWaveTrader.net, so you can read through that material a little bit more as well and see some additional education and instruction from Leo. So just Leo kind of had a question about when is this room open, and when are you in there posting analysis?
I think I am there almost all day long, but mostly, of course, during the American trading hours, from around 8:30 in the morning to the close. But I tend to be logged into this thing all the time, and I try to come back to you guys as soon as I can, usually within a few minutes from when you post and when you send me a question.
Yeah, so even if you're just somebody that can't be around as often during trading hours, which as Leo said, he's in there definitely all day trading day, and also some pre-market and post-market. Probably a lot more than he'd like to admit. He's logged in, but you can also always leave a question at any time. The room never closes, so that's a nice thing about the way it's set up. If you see there in the top right hand side of just any random post, you'll see that there's a number and then the word replies. And Leo, maybe you could just pick one of those and open it up for us. And what happens when you have a reply is that so you posted a comment or Leo posted a comment, you're now able to ask him questions directly and reply to that. Or if you were to have asked him a question, he would be able to submit a reply directly to you, and then you would see that in the thread. There's also even a little notification that our system will give you if you have a reply to one of your posts that's currently hasn't been read. So Leo, can we use the optimizer for futures trading?
Not right now. I mean, it's not a technical limitation. It's just that the data feed for futures is originally expensive, so there is no a business interest there to offer it, no. But you could replicate futures. I mean, most of these things can be done with equities, and I also, you have to realize, folks, that future options are a competing product of equity options, no. So if you have something like ES futures, like E-mini futures, you could do SPY share or SPY options or SPX options, and the same with gold. You could use GLD options, or with like oil, you could use USO or something like that. And in most of the time, I will say all of the time, equity options are way more liquid than the counterparts in the futures space. For instance, that myself, I never trade a future option ever. There is the liquidity is so dismal that there is no point for me to do it.
That's fantastic. So again, I want to give just an opportunity. If you have any other questions, please don't hesitate to submit them through. And Leo, if you could just, since we're getting closer to the hour, I did want to make sure you talked about some of the additional analysis that you provide in the room. Could you just do a brief overview of some of the other tools that come along with the Gamma Optimizer service? Obviously, the long optimizer tool in the room is really the center and the hub of the service, but I know you do have some other tools available, and just kind of discuss in general what those could be used for, just in case there's someone out there that one of those tools might be good for.
Of course, I mean, we have the long game optimizer, but we also have a few other tools like the momentum center, which, because the market is closed, I don't think we could see lots of it. Let's see what we get for the momentum center here. Where you can see intraday momentum action in the market. So, okay, yeah, you can see a few charts. The momentum center is very useful. It shows you the control chart, which for me is kind of, this is the way I visualize the market all the time. I don't really follow these kind of like price charts. They are useless to me. I like to look at the distribution of returns, and I like to identify like outliers on the distribution, like these red dots. Those things happen like 3 sigmas away, and I want to know what the intraday realized volatility, what kind of kurtosis we're having, you know, all sorts of technical stuff. And I also like to focus on the M5 trend, which is kind of a long-term trend, and I can see the momentum of the market in a longer time frame, and you know, you can see this tremendous positive momentum right now, and it helps me. It helps me to establish. And here, because the market is closed, I don't have like the intraday charts. We have two like intraday momentums, like a slow momentum from 10 minutes to like several hours, and a very fast momentum from like 1 minute to 10. And they are very useful. And we also have, to me, the Gamma Central, which I love. I love the Gamma Central. Is one of those tools that I really like. The Gamma Central allows you to see lots of information about different stocks. Now it really allows you to, for instance, let's look at SPX is good. I like SPX. It has several things. You can see it has too much information for me to demo here. I will spend like another hour, but it gives you a good view of what is going in the volatility world for any underlying that you can think of, American equity or index. It shows you term structure. It shows you the volatility cone for the past 7 years. It shows you the variance risk premium table. And right here, this for professional option traders, right here, if you are a professional option trader, you know what these things are. And I could explain it to you also. If you join my room, of course, I'll help you to use this tool. you can see the option interest, how it's distributed through time and through strikes. And so that gives you an idea where the puts and the calls are. And you can see, for instance, in SPX, you have massive concentration of open interest on June, which is not surprising because that's the end of the quarter. And those kind of things. No, also you have volume, and you can see if there is anything outside the normal in volume. For instance, this is was lots of calls for tomorrow. No, that's kind of interesting when SPX tends to be skewed towards puts, and you can see from almost all expirations we have heavy call action. So market is really bullish, I guess, on the SPX side. Everyone is getting calls for some reason. And you can see those kind of things. And you can also do earnings and binary trades. So I love the Gamma Central. It's one of my favorite tools. And also you can watch the open positions that we have, and you can see what we have right now. So we have well, right now we have a long spread open. This is basically a strangle, no, that I have open, and the downside leg of the strangle is gone, but the upside leg is profiting tremendously. So this is like what, about 500% return, more than almost 600% return on the long side of the strangle, and the short side is toasted, but I mean the total combined profit is gigantic. It's like 225, and the total cost was less than $1, so it's still almost 300% up the combined position. And I have a long-term butterfly also that is making good money. This is a very slow trade, and this updates real time. You can see all these positions real time.
And those are examples. Those positions right there are examples of things. The previous question about what do you get trade alerts in real time? That is an example of then they'll be continued to be monitored and watched until that exit alert is then sent to complete it, right?
Yeah, exactly. You just click details and it tells you. It shows you the original alert for the trade, and you can see what the trade is. So yes.
And I can just tell you that in working with a lot of members, I know some of these tools, especially for some of you that are brand new to options, they can be a little overwhelming. For me, I've been working with Leo for a while now, and still for me, so I only use a very small portion of it as I'm still learning my way. But there are helpful videos and information on the website, as well as we mentioned, inside the room, you have daily access to Leo. So you're not just pushed out there on your own to go venture off and learn this new tool. You kind of have this constant flow of not just help from Leo, but a community of other traders that are doing the same things as you, which I think is also a nice feature and very helpful. So if it sometimes looks a little overwhelming, it certainly can be, but it doesn't have to be. There's tools and support around to make it a lot easier, and you can kind of find your way. And we had recently had a meeting where we got to sit down with some members, and it was at the New York City Traders Expo. And it was amazing to hear how many people said, I had no clue what I was doing with some of this stuff at the beginning, and now I can't live without it. So I do think that over time, it goes to being this thing that you can't get your arms around, or maybe you're a little fearful of, to a tool that you just wake up and use every day. And you look at the charts and you know exactly what they're saying and how to read them, and they start to provide you benefits. So I think we're coming up on the hour here, so I just, on behalf of Leo and Dan, who was kind enough to share some time with us, I want to thank everybody that took time out of your afternoon to be here with us. We hope you learned something from the presentation. We hope you're taking something away with you. And most importantly, we hope that you'll stop into ElliottWaveTrader.net and take advantage of that 15-day free trial, not just to all the services that we offer, but especially to Gamma Optimizer, so you can see if it's something that'll benefit you. And Leo, you're already getting some thank yous on behalf of everyone that came in. So we really want to thank you for sharing your time with us and your expertise with us this afternoon. I really greatly appreciate it.
Thank you, Tom. And it's always fun to talk about Gamma for me.